Okay, hi. Yeah, now
Hey,
we're recording. Hey guys, so this is my first English language interview, and today I am joined by James Marsh, who is an independent trader in Chicago. How are you, James?
I'm really great, Pedro. Thank you for having me.
Yeah, do you go by James?
I do actually, yeah.
James? Okay,
Hey.
cool. Okay, so today we wanted to discuss um, the strategy of tail risk hedging,
hmm
for which James has a course on Gumroad, which I suggest people check out. I bought it myself. So the first thing, before we go into tail risk hedging, uh, can we go briefly through what is an option? Like what is the TLDR of a call option?
well, what is a call option?
Yeah.
Uh, Generally, a call is an insurance contract that you can bet on rising prices in the marketplace or rising implied volatility. Insurance. It's insurance.
Yeah. And right. So I wanted to, yeah. Um, yeah. So maybe you see the screen, but
hmm
um, what I think is cool about options is, the way a call option works is, really what happens is you pay a premium for it. But then what's really great is that an option will give you very limited downside and unlimited or unbounded upside. Um, and so usually when people talk about options, the power of options, or the reason why they're such a powerful instrument, is that they're nonlinear, and specifically they're a convex instrument. So for example, the call option benefits when the price of the underlying goes up. And likewise, there's also the put option, which likewise, in this case, benefits from the price going down, but it's also a convex instrument, which is basically if the price goes up, the value of the put option goes up at an accelerated rate. Um, and so I wanted to ask you a question, and I think this is important because lately there's been a lot of talk about hedge funds speculating and Wall Street bad people, etc. So can I ask you a question? Why would a hedge fund, for example, short a stock instead of buying a put option? Like if we see that options seem like such a great instrument.
Well, I don't know exactly for sure, but I'm sure many of them have combinations where they're using options. They could be using some sort of synthetic short too. You know what I mean? Where you think about it, where you're long calls and short puts, and you create a synthetic short, that way, or something like that. But I don't know. It's just
Because oftentimes what I hear is, people oftentimes say that put options are very expensive. Like people will say that options are really expensive. And so I guess for a hedge fund, it might be cheaper in a way to short the stock. Um, so, that's really part of the problem, right? Like it is cheaper than to buy a put option, but at the same time, you're exposed to a huge downside because like the price of the underlying might skyrocket, and then you're on the hook for a lot more than had you bought a put option.
right.
um
That's what happened to Melvin Capital or whatever, the hedge fund, the GameStop.
right.
Right.
And I mean, in that case there was both what they called a short squeeze and also a gamma squeeze, right?
Right. Yeah.
Yeah.
Yeah. I mean, anytime you see now volatility in GameStop still at like 300%, so that's been a heck of a short squeeze. So, but all it takes is one of those to end your career. You know what I mean? So you're like you said, that's a problem with naked shorting. And you're right. In theory, options would be better, but who knows what actual strategy they were using. They probably had options too, but maybe they just didn't know what they were doing. So
Okay. Yeah. Uh, yeah. Okay. So actually, what's the typical volatility for something like GameStop? Because I mean, honestly, I mostly invest in SPX.
I don't know. I don't know what it was over the last year, but I would say that, the stock had been in a downtrend for 2 years.
Mm.
So what I think what is going on, we could backtrack, is, this was part of the bricks and mortar trade with the Wall Street end, where they're shorting retailers that are bricks and mortar. So, like Foot Locker, all these other Macy's, all this other stuff to go down. And so GameStop, they were probably shorted for a long time, and every month it just dip lower. But I think what's so weird is when I looked at the stock, it's been like a $5 stock for like a year. So I don't know why they were still in the position after that. You know what I mean? Like, because usually, you're like, well, there's not much really to go. I'm sure you've captured all the gains, so it's pretty baffling what was going on. And I don't know what the volatility was then. I mean, probably I don't know. I just don't know. I wasn't low. I'm sure it wasn't single digits or anything, but I'm not sure.
Yeah. 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 Okay. So that being said, um, I think the other really nice thing about options, and the reason why, I mean, I think the Wall Street bet people, what a lot of them realized, and what a lot of people on Robinhood are realizing, is that for speculation, options are a better instrument than buying the underlying. And I think that's what has led to some of the, big speculation that we've seen on Robinhood. Um,
Yeah, but
but
I would say I think that talking to people that are on Robinhood, a lot of them are really interested in like gambling. You know what I mean? That's like what this is to them, and they don't really have a good fundamental basis of like of just options basis, like basics at all, which I find kind of atrocious. Like if you were to go on like a quant interview and they're asking you, you know option questions, and you came from Robinhood, they'd be like, nothing. Like, but I don't. It's fine. I mean, that's my opinion on Robinhood. So I mean,
yeah, no, that's fine. I mean, what I can say is, to be fair, I forgot his name. I think Tony Deden. He's a European value investor, and he's been investing for many decades. And he said that starting in 1996, 97, like, the price of a stock has nothing to do with the economic value of
yeah,
the
right.
of the company itself. And especially nowadays, when you have these companies with like huge technological leverage, like, there's really no way to get a fair price, because like electronic goods have like zero marginal cost of production. And so, like, what is the fair value of Amazon? Nobody knows, right? And so I think there's this trend where the fact that you can own a stock and sell it 30 minutes later at a profit, that makes the concept of owning a stock, like, you really don't seem to have participation in the company. Like, you just bought it because you think it's going to go up, right? And so, like, if you're only owning stock for speculation, it might be better to buy options just because they offer you a better, like, return on speculation.
Maybe, but I just think that the options are like, there's so much more delicate than that. You know what I mean? If you want to buy a call on something you think is going up, that's fine. But you should ask yourself, are you getting a good price from the call? You know what I mean? Because if you're not getting a good price from the call, then you might just buy the underlying. And if ironically, if you think calls might actually be undervalued if you actually think there's a big collapse coming because of the limited downside. You know what I mean?
Mhm.
So I don't know. It just depends. I mean, are you going to be able, if you buy, let's say you buy a 20 delta call, you lose, three times, but on the third time you make, 450%. Well, you're still ahead. You know what I mean? So it's kind of about being statistically passive, and it's hard. You gotta, I think, to be successful, you really got to ask yourself, am I getting a good price? It should
Mhm.
all be a price orientation. Like, Options trading is all about price orientation. Trading orientation, where you just have continuously do one kind of trade, like I saw butterflies, like this is nonsense. You have to be very conscious of what you're paying, because that's the only way it will work over time. You have to think about the average over time. So that's.
Yeah, agree. All right, so now that we talked about kind of like the market being somewhat more like valuations being more subjective, etc. We also live in times where the Fed injects a lot of liquidity into the markets, and they also lower interest rates, and we know for a fact that inflates the value of assets in general. Like it happens to home, it happens to other assets, and it's also probably happening to the market, right? Like actually,
Sure,
that's pretty much the proxy that they use, right? Like they lower interest rates, and then if the market picks up again, that means that problem solved.
Yeah. It's a never-ending cycle for them. But anyway.
Yeah, exactly. But I guess my question is, so the S&P 500, it's relatively consistent in that it goes up most years. In a good year, it may go up 30%, 35%, maybe more. But then on occasion, we have really terrible years.
Well, and think about it this way, you think about 2000 and 2008, and probably very nearly COVID. You can wipe out 10 years worth of gains, which is insane. I mean, that's like insane, or the worst case scenario, something like the Great Depression, where you wiped out like 90% of the market. And I know these are extreme things, but hey, this is something that can happen. It might not happen while you're alive, and every day there's a small chance it could happen. Very small, but it's out there,
Yeah, I agree. I mean, so I look at the markets from my Venezuelan perspective, because I think the United States is actually an outlier in that, equity in the United States has had an amazing performance.
Right.
You shouldn't assume that just because the market on average goes up 9%, that it's going to keep happening forever. Like you definitely should not assume that, in places like Venezuela or Argentina, like people paid a big price for being that optimistic.
Sure.
So now, before we mention a few things about the idea of tail risk hedging, a lot of the time when people think about tail risk hedging, they think about timing, right? Because a lot of people now are saying, hey, I think that the market is inflated, and so I'm going to keep all my money in cash and wait for a crash to happen, right? Or some people might put their money to bonds, though, well, probably not treasuries.
Yeah.
Or they might expose themselves to gold or some other thing. But I think what a lot of these strategies have in common is that they need timing in order to work. And so I think it's quite interesting. The idea of tail risk hedging is quite interesting to me because it doesn't necessarily require that people time the market. And so in your words, how would you describe the idea behind tail risk hedging?
Well, you're trying to find a payoff, find a product, or find an option that's going to provide a really large payoff on occasion, while having a more comprehensive strategy that allows you not to spend a lot while you wait for that to happen. So that's the thing, is like, it's like getting insurance, but not paying too much for the insurance that you end up bankrupting yourself while you're trying to protect yourself. You know what I mean? So, and you need to find, a product that's going to protect you thoroughly from a market event, and that's kind of the deal, and stay disciplined, and not, really important discipline, not to mess with the strategy.
Okay. So why, okay, first of all, why would tail risk hedging lose people money most of the time? What is it that they're doing periodically?
Because there's not a lot of crashes. It's just like most of the time the market is really quiet. Most of the time we just have all these. Think about think about earthquakes. We have all these little earthquakes all the time. They just go like this, and then you have 110. Every 10 earthquake or 9, whatever they are, massive one every 10 years or 20 years. And that's a great analogy for what the market is. It's just a lot of small moves, that don't have much effect on anything. And when you think about when you have all the money in trading for the most part is made or lost in the tail events, because what happens is you have a bunch of people that are caught. You know what I mean? They're the ones who have to sell, or they're the ones that are short and have to buy. So that creates like all this. That's where all the money is changing hands, when people get squeezed this way or this way. And if there's not enough squeezes, well then then nothing's happening. There's really nothing. And that's most days. Most days there's just little bits of movement. Some money changes hands, but in the grand scheme of things, it's nothing until you have a big breakout one way or the other. And that's a good way to look at it. Just like like an earthquake or a medium-sized earthquake.
Yeah, but I mean, so if that's true, then why is it that so many people in America, they put their 401ks in the market, and like they keep it there for 3 decades, and they're ready to retire?
I don't know. I mean, it's just, I think in the 80s and 90s, the U.S. became fascinated with the stock market, and it became like this vehicle to substitute savings, and people thought that it could do that. It could get them better returns, and it wasn't. And probably even on a risk-adjusted basis, okay, you have some more risk, but it was worth the returns you're going to get. But I think, as we've seen, it's much harder to do that than people think. And there's perhaps a lot more risk to getting those returns. It's like, oh, you want 8% a year. Well, 8% is a lot. It's like, you want 8% a year. I mean, you're a smart guy, compound interest. It's like, hey, this is kind of a big deal. So I think, you got to be careful about assuming how you're getting it, and what the risks you're taking. And I think the risks, we don't know. Most people are underestimating the risks, right? They're underestimating that, if you save for 10 years or 15 years or 20 years, that you really can have a serious wipeout still, and that's a big deal.
Yeah. I mean, I think so. Nassim Taleb, he explains it quite well, because he says that the financialization of society, it creates a lot of efficiency, which is true, but also, like, most people in America, they expect to make most of their money by investing in the market and not directly as a product of the money that they make, as their wages. And so that actually creates a lot of fragility if you're counting on that 8% return from now till your retirement.
Yeah. And in some sense too, and of course it's been made worse over the last 10 years, where we've made rates super low. So in some sense, even if people don't like it, they're being forced into it, which I think is kind of shitty by the government. But that's they've done that. So I think a lot of people are like, well, I have to do this. But the reality is we'd probably be better off. We'd have some trade-offs, but if there was more ability just to have more money in the bank collecting simple interest, I mean, at least that money's safe. That money's gonna be safer. It'll be around. The stock market, who knows? Is it going to be there? It's going to get wiped out at some point. A lot of it, I don't know. It's just we've created, it's a new world. For thousands of years, people had a business. You were a baker, you were wherever. You took your money, you put it in the bank. And that's all there was. And I think that system probably, in some sense, works pretty well for the most part. We don't necessarily need to have all this other stuff to make the world a good place, but we're, I don't know. I don't make the rules. That's just the way things have gone.
Yeah, I agree. And I mean, what ends up happening is, like, nowadays people are required to have a level of financial sophistication that ends up making the system inefficient in itself, because, like, nowadays, like, people have to learn a ton of finance just to make sure that they have enough money by the time they retire. And so
sure,
yeah, it's crazy.
And you're making people you're and from a psychological perspective, you're hurting people too, because you're saying, I'm going to force you to take a lot of risks to go to retirement and stuff like that, and that's not a good thing. You know what I mean? I don't think. It's like, okay, maybe your money, we have to put, of course the country needs some capital for, provided for business, all that stuff, but people also need some security. I mean, they need some reliance on probably some, just steady interest from a bank account, rather than just browbeating them into something that's really risky and then have them every, night go to bed with some sort of minor worry that one day the market will lose 50% or something. I mean, it's just, it's a, I don't know. It's not a fantastic way of doing things, I don't think.
Yeah, agreed. Okay, so going back to tail risk hedging. So the other thing that I think makes tail risk hedging really powerful is that you don't have to rely as much on timing, because here's the thing, like, the libertarians since the 80s, they've been predicting that there's going to be a big crash, and eventually they will be right.
Yeah.
But the market will go up a lot like before that happens. I was recently reading about the .com bubble, and people were warning about it for at least 2 years before it happened. But the market actually went up like 40% before the crash. And so, now, like since
But
2015, yes.
go ahead.
Yeah, no, because now like people have been scared since 2015, right? And like we've had a few like crashes or like almost crashes, but it doesn't end up happening. And what I'm saying is the market might still go up another 30% before there's a big crash.
Yeah, I mean, I would just, the only thing I would say though is that, when we've had bigger events, that they've wiped out years of gains. So sometimes if you sell 2 years early, you'll hate yourself and you'll feel like you won't want to hang out with your neighbor while he's bragging about his portfolio. But you may be right. I mean, because just the skew, the left tail of the skew, like you're like, hey, it can be really big. I mean, much bigger than people think. So there is that. But also too, people have to get a return. It's a huge problem. It's a huge problem. Staying invested, and staying in. How do you stay invested for the long haul? How do you invest for 25 or 30 years and keep your portfolio intact without having a crash that causes you to sell everything and then you lose, a bunch of returns? I mean, it's a huge issue. It's, I don't know. No one talks about it, but I don't, but it's there. It's like, how do I hold on for 30 years or 25 years or whatever? It's a long time.
And so how do you personally deal with, these periodic losses, right? Because I assume that you also hedge your tail risk. So how do you personally learn how to, deal with like that periodic loss?
What do you mean, like periodic loss? Just like
so if you buy put options, like, every 3 months or so, like, most of the time you won't get that money back. Like how do you train yourself to, tolerate that psychologically?
You try and, in theory, I should, with a tail, with like the strategy, you should have, your losses should be really low. So it shouldn't be too bad all the time. But I agree, it's psychologically, it is challenging, because it is a little bit like Chinese water torture, where you have some little bit of losses and some little bit of gains, but you don't get much in the short term, and even the medium term you don't really get that much of uh of anything to show for it. But I think what happens is you have to just tell yourself, well, over the long haul, this is the thing to do. It's like, if I don't have this and something happens, then I'm going to be really messed up. But you're right. It's kind of, it seems like you're wasting your money, and you got to be really careful not to pay too much for the options. You got to make sure the strategy is set up that's appropriate, and yeah, I don't know. I don't have any easy answers. That's just kind of the way it is. It's just kind of,
I get it. So the way I try to explain this kind of strategy to people, and a lot of business people get it, I think that in a good investment, you cannot calculate the expected return.
Sure.
Like, this happens when you invest in a small business, right? Like you don't know what's going to happen. Like maybe you lose that money, or maybe you'll get a 500% return. Like you
Right.
don't know. So the idea is, well, I might as well expose myself. On the other hand, investments where all your cash flows are totally predictable, those usually give you a huge downside, right? Like if you buy, I don't know, like Venezuelan bonds, or if you buy, I mean, even if you rent out a home, like you have very predictable cash flows, but if COVID happens, then you won't get any money for a year, right? Like that
Yeah.
that that happens too.
Yeah, I mean, sometimes I think businesses, there's a tendency in the US, especially, I think, for companies to manage their earnings. They smooth out their earnings. And then if they have really steady earnings, like, maybe the banking system had steady earnings, but the reality is were just making a lot of bad loans that just hadn't shown up yet. So I think there's stuff like that. And I think that's something people, need to pay attention to. Like I'm pretty interested in risk management. I want to get more into the subject, maybe on like a personal and professional level. But it's like, or if you're like a business person, are you examining the scenarios, how you're making money, and making sure that you're not hiding something from yourself, where you're secretly betting against an event, or betting against something happening systematic. You know what I mean? Where it's like, we've built this strategy, we make all this money, but we know that there's this little thing right here that can screw us up, but we're just betting against that all the time. And you're kind of like, well, is that really a strategy? I don't know. But you gotta be honest with yourself and just say, do we have a hole, like a gaping hole that and I don't mean like a one-off event. I just mean like something they're just like, well, this is really just nonsense, because eventually something's gonna happen because this little thing is sitting out here, and then we're gonna be screwed. So it's kind of, I don't know. I mean, it's probably most businesses aren't doing that. They probably have more just random events or market downturns that can end them. But I don't know. It's there. I'll say,
Yeah.
remember like in the oil, remember the shale crash? You know what I mean? It's like, I guess they were all making the bet the oil would always be above $90 a barrel. And you're like, okay, maybe that's a reasonable bet, but it went to like 30 or something like that, and I mean, it just destroyed the whole industry. And that's so.
Yeah. So speaking of risk management, there's something you said in one of your videos which I really liked, and that is, usually when you talk about risk, you need to also mind that a lot of things might happen together.
Yeah.
And I was actually thinking about this because I was looking at a mortgage loan, and you have two options where you might either like get a really low rate for 10 years and then floating, or you might get like a slightly higher fixed rate over the whole term. And what I was thinking at the time is, well, if I make enough early payments, like the 10-year arm seems better. But then I was trying to be really pessimistic, and I thought, well, if interest rates go up a ton, what's going to happen is that a lot of the homes will depreciate. And so even if I'm in that situation, it's going to be a double whammy for me, because the payments are going to get really expensive, and then if I want to buy the house, it's not going to be worth nearly as much as what it is now. And so I think it's important when people manage their portfolios that usually bad things, they don't happen, they tend to happen together. So like if you have a portfolio of investments and interest rates go up, your investments are not going to benefit from that. And then, your payments in the home will go up, and then your house will depreciate. So you need to think that a lot of bad things will happen together. And
not only that, but like, what's the term, like sub additivity? You know what I mean? Where you're like the probability, the probability of all your bets. So it's like, you don't want to make sure that in correlations, where you don't want to make sure that you're so correlated to a bad event, where it's like, what happens on the worst day? It's like, I lose my job, the market drops 50%, and my house goes down. And that happened to a lot of people in 2008. So you're not diversified, you're just being obliterated, and so it's like, you got to think about, those things, those larger issues. You're right. Just like stuff adding up and not paying attention, that the knockoff effects, other things are going to happen at the same time. And I'll give you an example, like another example I was thinking about the other day is like I have a friend, my neighbor is a really good old neighbor, is a good friend of mine, and he's like trading more and options and stuff like that. And I'm kind of like, it's fine. I'm not trying to, we talk a little bit about it and I'm not trying to discourage him. But I was thinking about the other day, what happens to people is that if you get involved in trading and you have a full-time job, you got to be really careful not to screw up your work performance, in which people don't think about that. Like you're trading too much and you get, and like your boss is like, what are you doing? You get fired. Or what happens is that the market goes down a ton and you're so stressed out because you've lost half your retirement. Then you get fired. You know what I mean? So there's like other things going on that, are, you can't just always focus on this one thing. And I think that's kind of like, it's like this meta risk management system you have to be going. People don't realize that too. I mean, think about what would happen if like all these crypto firms, like, these guys, they're out at work and they run these exchanges. Well, what if crypto loses 90% of its value, which it could? Not only are everybody going to be at the firm be personally bankrupted, because they have a lot of crypto holdings, then the firm's probably going to be bankrupt too. So it's like you have this whole thing where it's like you got to think about the whole picture, that things are the second order effects, things are coming at you that you wouldn't have thought about, the meta picture, and that's, so anyway, that's my thing.
Yeah, agree. Okay, so yeah, I mean, I think that's, like that's what I wanted to go through. Thanks for going through that. I would advise people to check out your channels, right? I mean, you're on
I'm
Twitter.
slowly been trying to work on like a YouTube channel for just for various risk topics and stuff. So yeah, I mean, I've it's a little work in progress building a YouTube channel and making it look professional, but I'm working on it.
Yeah, no. I mean, I see that you're an enthusiast of Rory Sutherland too.
Yeah, he's an interesting guy. He's a great writer. His book Alchemy, I think it's great. He's a great writer, and he's very smart, and he's kind of the kind of person where, if you're involved in trading, people are less, we tend to be kind of logical, you know what I mean, to a certain extent. So sometimes reading him about like marketing and sales, I think is kind of good because, people are not, they're selling to them or figuring out what they want is, whole confusing, I don't know. I don't get it. I mean, it's hard, I mean, thinking about what people want and how they're motivated psychologically to buy stuff. I think he's really interesting. So
yeah, for sure. And you have other projects going on, right?
Working on selling my own little coffee brand, but that's been kind of, I work on that an hour
Yeah,
a
I
week.
saw that.
Yeah, so it's hard, but it's a project, spare project. So
yeah, no, of course, of course. I mean, where do you bring the beans from?
I have a roaster I contract with too. So
Okay.
for the moment, but I don't know. It's the kind of thing where probably would need maybe a partner, stuff like that. But it's for the moment, it's just been, it's not costing me a lot to run it, and then I can at the moment, and then I can just add a little bit of money in here and there and just try and see what works. You know what I mean? Stuff like that. So
Yeah. I mean, so I was listening to a podcast with Joe Norman, and
yeah,
I think his name's Snyder. I forgot his first name, but like they were talking about, like when you focus on homesteading, you develop a lot of skills, and you can reach a level where you don't have to do it, but you're good enough that you can do it if you have to. And so I think when it comes to owning a business, I think there's a lot of skills that you can learn where you don't need to get a PhD, but you may learn enough that it will help you in your next business. Like,
yes, for sure.
like if you don't know anything about accounting, you might learn a little bit just to make sure that your accountant doesn't swindle you. And then, like that'll help you in your business, right? Like, and so the idea is that if you develop certain skills that will help you no matter what you work on, like that gives you the possibility of pursuing several businesses at the same time, right? And so like that also gives you a pretty good risk profile.
Yeah, I think for anybody, just just starting, trying to take a little time and start any kind of business is a good thing. And just even if it doesn't work out, you just say, hey, I'm going to sit down today and I'll try and do this, and I'll put 6 months into it here and there, and you learn. I think you learn a lot, and then there's a lot of things you don't realize ahead of time. Like for me, I would say just these little side projects. What I've learned is that building anything is hard, obviously, and what I found out is that it can be really like it can bring you down. You know what I mean? You're just like, oh, I'd like this to work. So and I can see why people give up. You know what I mean? Because it's painful. And you're like, oh, I'd like to do this or that, or I'd like to try this, make some money doing this, that. It's really hard. It's really painful. So you get up, sometimes in the morning and you're like, what am I doing? This just sucks. But I think just knowing that how you feel from that is something you're going to be able to understand in the future too, and that's something I realized. And the other thing is, lately I'm realizing like, well, maybe you want to create a product or a service, but I'm realizing like you might want to think about how you're going to market it as much as as the product and the service. So that's something lately I've kind of thought about it. Like, yeah, I'm like, this sounds like a great idea. I'd like to make this, but maybe if I invested 50% of my time in like how I would market it or figure out how to sell to someone, that might have been more useful than just saying, just make this. You know what I mean? Like, what are the channels? Like, who do I need to go to? Who's going to buy this? It's kind of, I don't know, just stressful. It's hard. Yeah. It's very hard. So
cool. So I don't know, anything interesting that you're reading, anything that, any books that you think people should be aware of?
Maybe I actually, right now, I really haven't been reading a ton. I've just been so focused on just like these side projects that like just doing the YouTube channel and just trying to set up that my reading has gone like way down the hill. I just read the standards, I'm on Twitter, I talk to people, but I haven't really jumped into a book in a while. So I don't know, bad answer, but that's kind of where I am right now.
Yeah, that's fine. That's fine. I was reading, I stopped reading it for a while. The book by Spitznagel.
Oh yeah.
Yeah.
I've read it. It's actually on bookshelf over by me.
Yeah. Because he wrote a second book and it comes out later in the year, and I think it might touch on things like tail risk hedging.
Yeah.
So yeah. All right. Cool.
Yeah.
Yeah. So I think that's all I had. So yeah. Thanks a lot, James.
All right. Thank you. Say gracias por enterarme or whatever. Thank you for having me. Sorry.
Yeah. No, that's fine. I'll figure out how to write subtitles for this. I mean, like some of my relatives at home, they watch my videos.
Okay. Well, thank you. It was really nice meeting you. I really appreciate us getting a chance to talk.
Yeah. All right.
Likewise. All right. I'll see you soon. Take care.
Mm-hmm.